Welcome to the CLS Monthly Market Review. I'm Rusty Vanneman, President and Chief Investment Officer at CLS Investments. And with me this month is Kosha Edis, Senior Portfolio Manager at CLS Investments. Kosha, welcome.
Great to be here.
We have so many fun topics to talk about. But first of all, let me talk about the market. It was a great month in the market. Again, April had strong returns in virtually every equity asset class. For the year, we've got double-digit returns, and again, all the different equity asset classes. It's a great year to be a global multi-asset manager like CLS is. Of course, sort of the weakness is the international markets, including emerging markets, are a little bit softer, and they were again last month, which means relative to our own benchmarks, we're a little bit behind on the year. But it's been a very good year in absolute terms. So, despite all that good news, investors are still worried. And one of the things they talk about right now is we've had such a strong start to the year. Now we're in May. They're sort of this saying, sell in May and go away. What is that? What are people talking about?
Well, it's clearly an American phrase because being from Russia, I haven't heard of it. But it's the notion that the period between May and October generally has below average returns. And there actually is some truth to that. It is below average, but the key point is it's not zero or below zero. So that there isn't really, you really shouldn't be going to cash because over the last 50 years, as you wrote, the return between that period, May and October, has been about 2% on average, and the market's been positive 70% of the time. I like those numbers. I like those odds. And then there's a few things going for us this year. First off, it's the third year of the presidential cycle, which tends to be positive. We had a pretty crappy year last year. Typically, the year after tends to be quite a bit better. And then you included some research from Ned Davis, which is a great research provider, that showed that there's certain sectors do quite well, like healthcare and staples. And we tend to like those sectors right now.
I think you just nailed that whole section that I wrote. Every key point, you just nailed it. That's great. Good thing I told you we were doing this a few minutes ago. So again, just to restate it, so again, there is some truth to the fact there is some weakness this time of year, but it doesn't make sense to move to cash because the stock market is still most likely going to be cash. Never mind, you're going to have transaction costs, probably tax costs, and just the whole timing of getting back in the market.
Of course.
So there is some truth to that, but there are some things that go on within the markets, such as some more defensive sectors, such as healthcare and consumer staples, which we kind of like right now. Kind of the reason why we've underperformed a little bit relative to benchmark so far this year. So anyway, that's good stuff. All right, so we looked at history there going back over the last 20, 50 years and going back even more on the seasonal patterns. But something else we wrote about is talking about just looking back over the last 20 years and looking at some of the returns that have taken place in the market. And again, I personally think there's a lot of little nuggets in this, and I know you do too. So we're going to play a little game.
Oh, okay.
And I'm going to let you go first on this too.
Oh, boy.
So again, you think there are a lot of nuggets in there? I think there are a lot of nuggets in there. So looking over the last 20 years of history of asset class returns, what is one thing that stands out to you? And then I'll take one, and then we'll just kind of hand it off.
Okay. Well, I'm going to take the easiest one. Number one performer has been emerging markets, emerging market equities. They've had great returns, and I think that might surprise a lot of people.
Despite the fact it's underperformed the last 10 years.
Exactly.
Well, it makes sense because that is where the economic growth has been, the demographic growth has been, and so it makes sense. Okay, here's one that I thought was really good. Now, when we looked at those returns, it wasn't just the asset classes. I forgot to set this up a little bit. We also looked at the average investor in the U.S.
Right.
We also looked at housing prices. We also looked at inflation. And one of the big takeaways is that the average investor has dramatically underperformed the markets. And even if you look at a U.S.-based U.S.-based balanced portfolio, the average U.S. investor is underperformed by 3.5% per year for 20 years. Beat that nugget.
Oh my gosh, that's a tough one. Well, I'm gonna go bottom of the barrel fishing here. You ever heard of long-term bonds?
Yep.
Not too many people invest in them.
Well, actually, it's probably the most one of the hated asset classes over the last 20 years.
It has, over the last 20 years, returned the same amount as the U.S. stock market. I think that's pretty staggering. Definitely kind of underappreciated.
That is a huge point. I'm glad you brought that up because, again, I think, both of us talk to advisors and investors all the time. People hate bonds. They've hated bonds really for 20 years. And long-term bonds have done really well over that time frame. Now, of course, that's over the last 20 years and going forward. Just to put in a plug in, and because I just reread it again this week on an airplane, is our white paper we did a few years ago about how bonds perform in rising rate environments. You've written a lot of white papers here and a lot of really good ones, but I think this white paper is one of our most important ones. And this is probably the only one you didn't write, actually. I'm sorry. But it is but in rising rate environments, bonds even do
Right.
well. So I think that's really important. Okay, so I'm going to take one more nugget. So going back to the average investor, and so the average investor, not only they underperform balanced portfolios, but they've also underperformed inflation.
That's
And
the
that
worst.
that is really big. And there are a lot of reasons for the underperformance of investors. And it's, you could say fees are part of the equation, probably overplayed, as an excuse. You could say active management, and instead of, staying, instead of just following the markets, you actually have an active approach. That's a little bit, but again, that's really way overplayed. The biggest thing is just not staying balanced, staying the course with an appropriate portfolio. And investors kind of have that behavior gap where they're kind of moving around all the time and making the bad decisions. So that's really the biggest reason for the gap.
I think people really forget about inflation sometimes.
Yeah.
Basically, what you described as being in the bank in cash loses you money.
Yeah.
I think people just don't think about that because it's not tangible, but it happens.
That is, building wealth, real wealth is really the name of the game.
Right.
All right, so that is looking over the last 20 years. Of course, one thing we talk about is looking at forward returns or expected returns. And at CLS, we create all our own expected returns on every asset class, every ETF. And what we call is the CLS Edge Score. Tell us what the CLS Edge Score is.
This is our forecasted return kind of measurement. Used to be called the Rusty score, but we cleverly renamed it the CLS score. It's a build-up approach. Starts with the equity risk premium. Then we add on kind of our core kind of components that we like to evaluate. Valuation being the key component, but also very important to overlay momentum on top of that.
Yeah.
So that's how it's built.
Well, the edge score is really important. One thing I would like to note is that the valuations are really important. We're in the land of Warren Buffett, and obviously
Right.
influence us greatly. But valuations really only drive it when they're at extremes. And so if it's not an extreme, the other factors such as momentum actually drive it. Okay, we're going to play the game here too. So
Another game.
Yeah, exactly. So we're looking at expected returns going forward.
Okay.
Of all the expected returns we're doing, what's a big takeaway for you right now, looking at the CLS Edge score and the major asset classes?
I'm actually going to play on the historic and say emerging markets are once again forecasted to outperform not just domestic markets, but do much better than they have been doing in recent years. Like you mentioned, the last 10 years they've lagged. Our expectation is over the next 10 years, they're going to be the top performers.
Again, a huge takeaway, and it's not just expected to outperform, but significantly outperform. And in the commentary, we talk about how we look at even capital market assumptions, or another way of saying expected returns from other firms also say the same thing. So emerging markets has been the place to be over the last 20 years, and it's probably going to be the place going over the next 20 years. So portfolios should have that emphasis. Well, I've got one takeaway, and we'll wrap up. And my takeaway is actually going back to fixed income.
Okay.
So again, interest rates aren't high. Expected return potential isn't necessarily that extraordinary, but remarkably competitive with the U.S. stock market.
Right.
U.S. stock market is looking to have positive, albeit below average returns, and fixed income actually be competitive on a total return basis and probably superior on a risk-adjusted basis. So again, the message is don't give up on fixed income in a multi-asset portfolio.
I like it. Good message.
All right, so that was fun, huh?
I loved it.
Great.
I loved it.
Well, great. Well, thank you for your time and trust in CLS Investments, and we'll see you next month.